Okay, so good morning, everyone. Welcome to today's macro snapshot. I'll keep it relatively quick because there's quite a lot of stuff going on this morning, guys. So Thursday, November the 30th, month end, could be a bit of volatility and rebalancing. So the 30th of November 2023. First of all, we have, as we speak, we have the OPEC Plus meeting happening virtually, but technically sort of in Vienna. Basically, what's happening here, let's just look at this sort of tweet here from Pierre Andorran, is one of the world's biggest oil traders. Kind of interesting because we know that the Saudis have been unilaterally cutting by about 1 million barrels per month. And what we're discussing, or what they are discussing at the moment, is the Saudis seem to be wanting to push other OPEC Plus members to cut a little bit more. But they seem to be getting a bit of resistance. And as just is a good tweet here because it just sort of puts everything in context. So if you actually look at what's been going on over the last sort of 12 months or so, he says it makes sense for the Kingdom of Saudi Arabia to ask Russia and other OPEC members to chip in. So you see here that the Saudis produce 25% below capacity. Russia seems to be about 5% below capacity, and the others between 5% and 0 below capacity. So the point here is that Saudi Arabia is doing all of the heavy lifting. And what Pierre Andorran is suggesting here, that it kind of would make sense, at least from a price perspective, is that if every other OPEC Plus member was making the same effort as Saudi Arabia, that would correspond to an actual production cut of about 5.25 million barrels per day, much more than the 1 million barrels a day we're having at the moment. And in his view, Brent would be trading, basically double at over $200 a barrel. And then he says, well, an actual 1 million barrel per day cut from the others, which would be corresponding to a 3% production cut across the board. So if everyone else did a million, that would equate to 3% across the board, would probably bring prices to 95. A 2 million barrel cut with everyone, which would be 6% in total, would bring prices to about 120, et cetera, et cetera. So Pierre Andorran here sort of arguing that it would be in all of the members' interest to sort of chip in and help Saudi Arabia. But basically the information we're getting just coming out of, across the Twitter sphere is that actually at this point, there's no particular decision. There's some kind of talk that, that haven't come to a decision. So if we just look at the price action here on a 3-minute, there was a little bit of a spike about 5:30 when the rumors were coming out that the Saudis had, maybe convinced everyone to sort of cut a little bit more. And then the rumors crossed the wires, basically saying here, you see this big red candle here, basically saying that the Saudis would simply extend their own 1 million barrel cut. So just to be clear, I think what the market's expecting, the market's going to be disappointed until and unless there is a significant, either the Saudis expand their cuts from, let's say, 1 million barrels a day to maybe 2 million barrels a day unilaterally. And also if the other OPEC Plus members maybe come up with, let's say, a combined total of 1 million. So I think a minimum to keep the market from sort of dumping would be an extra million, either from the Saudis or the other OPEC Plus members. And then, what would disappoint the market as well, I think if there's no change to the status quo, the Saudis continue with 1 million. And that I think would cause the market to have a pretty nasty sell-off of a few dollars. I expect that we'd probably test down another, a few dollars at least. So that's what we have to be looking out for. But I think really the bar is quite high. The Saudis and the Russians and the other members will have to come up, as I say, at least with a new 1 million barrels, preferably maybe 2 million barrels, to really get the market's attention. I think anything less than an extra 1 million barrels will cause a pretty significant sell-off. And if we actually just put that on a daily chart here, just to put it into context, I'll put it on the January contract here. I think, we might at least, I think, to be honest, we would probably test down here, maybe at least down to like the 72, 82 levels. I think we'd get, at least a $5 or $6 sort of sell-off. On the other hand, if they come up with, as I say, an extension of the 1 million barrels and maybe another 1 million barrels from somewhere, and obviously anything more would be positive, for sure, I think we could start to retest, up here, something like that, another, $6, $7. So all to play for at the moment. I believe they're in the technical meeting, probably around about, 8:30, 9 o'clock, we'll get some more headlines and gossip. And just keep in mind, guys, that in the past, the Saudis have shocked at the press conference afterwards. They have occasionally just sort of dumped something on the market, so there could be a bit of a shock there. Other things to look out for: we have some interesting data coming up at 8:30 in about an hour or so. In the US, we have pretty interesting here. We have initial jobless claims. Keep in mind that last week that actually was pretty low, 209,000. The market's expecting that to go up to 218,000, which is still very low from a historical point of view. But really, the context here is that we have non-farm payrolls next week, and the context here is, is the U.S. labor market strong? Is the U.S. labor market still able to spend? Because if there's still jobs, they'll still be spending, and we'll get a bit of. So let's keep an eye on that, and also the continuing claims. We also then get the personal income and spending. I think the most important one here is probably the personal spending, because there's this idea here that the U.S. is having a soft landing. It's not really going to a recession, certainly not a hard recession. And that depends on the American consumer to keep on supporting it, basically by keep on spending. So let's see what happens with the personal spending here. The other thing as well, which is sort of interesting, is we get some updates with the PCE. The key number here is the core deflator month over month. Keep in mind yesterday that we had the third quarter PCE revised down just a little bit, but we actually had the GDP, the second reading, was revised upwards. So that's indicating that, as far as the Fed's concerned, the inflation seems to be floating downwards, but the economy is remaining robust, which is like a perfect Goldilocks scenario for a soft landing. So we're going to get a bit more information here. Obviously, we know that the PCE core is the preferred gauge of inflation for the Fed. That's for October. So it's slightly old. Well, I don't want to say old data, but it's not the freshest data. But still, the market will be looking at this monthly number very, very carefully. And the thing here is that we all know that there's been a large bond rally, as we all know. So I'll just put it on, pick your favorite bond. Let's just look at a few yields here. So we see that, basically the narrative here is that the Fed, this is on the comments that we're getting a soft landing. It was also on the comments we had the other day from Waller and to a certain extent Williams, essentially sort of hinting that, the Fed was done. The market has taken that and run with it. And at this point, we see that the yields on the 2-year have come down very, very aggressively. Also on the 5, a little less at the long end of the curve, the 10s and the 30s. But basically all across the board, the idea here is that the Fed is done. In fact, they haven't really hiked since, well, in fact, they haven't hiked since July. And the idea is that the pause might be sort of shorter than we thought. And if we actually just look now what the market is pricing in, we can see, let me just bring this up, guys. That the market has actually brought forward, let's see if I can squeeze in here, just put on the, both over in Europe. In Europe, it's now in April, calling for a hike in April, or pricing in a hike for April. And if we look over in the US here, we can see that this has gone very, very fast. I mean, we now have a full 27 basis points, which is more than one cut priced in for the May meeting. But what's pretty extraordinary for me, at least, is that we now have 11 basis points priced in for the March meeting. So if we just look at the way that's moved, I'll just put this here on the expectations here. Let's say on a I don't know, 1-minute chart for the last 3 days here, you can just see how fast those expectations have moved. So you can see, let's have a look. I'll just kind of squeeze this up a little bit. That basically when Wallace spoke, we see that for the March meeting, there's only 4 basis points of cuts priced in, and that's really sort of accelerated to almost like a 40-45% chance of a cut. That to me seems a little premature, but it's interesting because I was thinking about it and reading various articles and whatnot. If the Fed now believes that rates are restrictive enough, the point is that if inflation expectations are going down and realized inflation is going down, actual inflation is going down, if the Fed does not cut, that means that the real Fed rates, the real Fed funds rate is actually becoming increasingly distanced. The spread is becoming greater between the inflation rate and the Fed funds rate, which means that the real Fed funds rate, the amount of restrictiveness in the economy, is getting more and more, which is too restrictive. So the Fed at this point, remember, what they want is a slowdown in inflation and a very soft, gentle slowdown in economic activity. If inflation is coming down, it's not in the Fed's interests or the economy's interests for them to keep in a de facto way tightening the real Fed funds rate. And so what a lot of people are saying, and this I think is interesting, is that if the inflation continues to fall, the Fed might almost mechanically just bring down the Fed funds rate, just to keep the distance between the two, the degree of restrictiveness constant. And this is something which Waller alluded to the other day, saying basically sort of saying that, you know, it's almost like a mechanical relationship. And that implies what? That implies that the Fed doesn't actually need a recession to cut rates. The Fed does not actually require a recession to cut rates. What the Fed requires potentially is just a lessening in the inflation rate. So we could get a situation where inflation just sort of slowly drifts down, the economy remains relatively robust, and the Fed just almost mechanically, in order not to keep a too restrictive Fed funds rate, just slowly lowers the Fed funds rate. Very interesting. So what that means, and then the market is going with that, and essentially saying, as we saw, that you know, that basically we're going to get cuts as soon as May, and even now pricing in, you know, 45% chance in March. So very aggressive, bringing that forward a lot. That's of course causing a short end red bull steepener. We've seen the curve steepening over since the comments from Waller, and we're seeing this morning that the curve continues to steepen, which is good because we have a little position on that along the steepener there, so that's good. So let's see what happens there. And if that's the case, if we have yields coming down, of course, that's going to be you know, potentially a headwind for the US dollar. Although you could say at this point the dollar has come off a lot, as you see here this morning, up a little bit, hitting a fib level here. So this is the 61.8%, beautiful technical fib retracement level there. That's pretty good. So that's going to cause a little bit of downward pressure on the euro, because at this point, although the Fed is being dovish, we also have sort of dovish pricing over in Europe. And in fact, this morning we saw we've been seeing from Germany, Spain, France, and Italy, much, and did I say Spain? Spain as well, much lower than expected inflation. So inflation seems to be coming down the core as well in Europe. And so that's also leading for a pricing in of cuts. I think in April is the first cut priced in for the ECB. So the point is that it's not that the Fed is the only dovish game in town. And we've had, you know, pretty significant sell-off here of the dollar. So interesting, just a bit of a technical bounce maybe there from the 68%, 61.8% retracement. So just was seeing again the euro pretty much the opposite of the Dixie there. Let's see if like some of the commodity currencies also just taking a little bit of a breather from a lot of these are just like fib levels, retracements just taking a little bit of a breather. So also gold, let's have a look at gold. Gold, of course, has had a big run up, as you guys know, gapped up yesterday, just taking a bit of a breather here. I mean, to be honest, if the real rates continue to stay lower, nominal yields continue to go, and the US dollar doesn't accelerate too much, you've got to say that gold, you know, might try and retest these quadruple top. That would be a quadruple top here, going back all the way to 2020 here. But that will be quite a lot of resistance. But I think if it gets through here, of course, we could test a little bit further. And what gold, it's interesting that if the Fed is perceived to be less aggressive on rates, ordinarily that would be a positive for gold, just because of the nominal yields coming down and real yields coming down, but also just sort of from a symbolic point of view, this idea that the Fed is attacking inflation less, which all things considered, you know, might be a bit of a positive for gold. But at this point, one would, you know, depending on your time frame, probably it'd be interesting to see if this maybe test down into this gap level. That's something I'll be looking at. So that's about it, guys. We're going to get back and look at the market. So I'll just have a quick look here at the volatility. We had a tiny bit of vol going up here. We have Powell speaking tomorrow. He may or may not speak about monetary policy. It's going to be interesting to see if Powell pushes back or not against what's been happening in the market and some of the comments of Waller. But just in terms of the equities, just kind of pausing here. But you've got to say that if the PCE comes in cooler than expected this morning, presumably that will lead to the yield selling off a bit more, or the bonds going up and the yields coming down, which in theory should be a positive for the equity indices here. So you see here that the ES pause, you know, at a nice level here, could either sort of fall or go higher, probably depending on the PCE numbers. And we also have Chicago this morning, and the same thing here for the NASDAQ. So that's what to be looking out for. That's it, guys. So let's keep an eye on what OPEC has to say, and then, of course, what Mr. Powell has to say tomorrow. Thanks so much. We're talking again soon. Thank you.